Hey guys, welcome back to part 2 of getting your daily bias. Part 1, we had introduced the 4 pillars to you, which was fundamentals, market sentiment, market conditions, and technicals. Now let's actually dive into the charts and see what that looks like. So as I told you guys in the previous video, we want to have a bias before we even get to the chart. So let's see what that looks like. So there is 2 tools I use for this. The first you guys are all familiar with. It is Forex Factory. I will go here and I'll basically see if there's any major red news that affect my asset. My asset is XAU USD, which is gold being traded against the US dollar. After I'm done looking at this gets me my fundamental bias if there's anything major. The next thing I do is I go to Market Edge AI. By the way, if you guys like this tool, in the description below, I'm going to leave you a 10% off coupon that Market Edge was nice enough to provide to our followers and subscribers. There is a few parts of this that I'm going to show you, and this is very important because if you could get this right, I would say 70-80% of the time you could formulate a bias that's the correct direction without actually looking at the chart. So first, I am going to head over to the economy. This is where it's going to show me my assets. So I'm only looking at the US dollar because we're trading gold against the US dollar. And you could see Market Edge was nice enough to put out the interest rate. I could see inflation's coming down. I could see inflation's upticking a bit, but not out of control. GDP's going down. The rest of these I don't really care about that much right now because they're kind of staying fairly level-headed. Whereas if they start climbing up or climbing down, then they become something I'll consider. So at this point, I am considering interest rates, I am considering CPI, and I am considering unemployment rate, and obviously GDP. GDP's going down. That's expected with everything going on. So right now, what I know is the interest rate's been staying the same. The market's pricing in a cut. The cut's likely to happen sooner than later because inflation is going down and unemployment's slowly starting to climb. So that is slowly gearing us up for a scenario where a rate cut happens. Next thing we're gonna go look at is we're gonna be looking at the market sentiment. So we've just discussed fundamentals, interest rates the same, jobs are slowly declining or slowly rising, inflation slowly going down. Or sorry, I got that mixed up. Unemployment slowly rising and inflation slowly declining. Anyway, that's my sentiment. And what that's telling me right now is the interest rate really doesn't have a huge push. So if we start cutting rates, that is going to make gold more attractive and gold is more likely to be bullish. If we're raising rates, gold is less attractive and the dollar's stronger. Right now, inflation is the only main thing that's actually a driving component. So we have inflation and we have jobs. Inflation's coming down and unemployment's going up. We're getting closer to a rate cut. Until that rate cut actually happens, the interest rate themselves aren't that important. So what does that mean for us? That means for us, we got to look at the market sentiment. What kind of sentiment scenario are we on right now? We're currently in a risk-on scenario. Why do we have a risk-on scenario? China, US have a truce on the tariffs. We're getting closer to a Russia-Ukraine peace deal. India and Pakistan had a ceasefire. So these are all reasons for the US dollar to gain strength and the US stock market to basically gain investments. Now, when a risk-on scenario happens and the stock market gains investment, usually safe havens lose investment. Whereas when war happens, trade war happens, and market uncertainty happens, everyone starts panicking, selling their stocks. We go into a risk-off scenario and money pours back into safe havens. Safe havens being gold and Japanese yen and the Swiss franc, as you can see. So you can see right now we're selling our safe havens and we are buying into the markets such as the S&P 500. So right now I have a bearish bias on gold. I am going to show you a trade I actually took that I talked about in part 1 where I literally shorted based on sentiment and fundamentals. So let's jump on the chart and discuss that. And I will touch market conditions and technicals a bit. After this video, I have a plan to release a course for you guys, Forex trading for beginners, intermediate, and advanced traders. And it's going to include everything I do for technicals, obviously on YouTube for free. So you guys will want to definitely subscribe, as that's coming for all of you. But today we're going to talk about fundamentals, sentiment, conditions, and technicals, how to put it together. Whereas the next video, I'll actually break down multiple videos of how technicals alone are done, as fundamentals themselves are all in the Trading Bible, which is available to you guys for completely free. I'll leave that in the description for you as well. You're going to want to subscribe to Momentum's email list, and it'll basically get sent out to you for free. And everything I do is in there to recap this. All right. So I shorted this trade here. So there was I actually took a couple of good shorts. So I ended up shorting this and this. For the sake of this video, we're gonna break down this trade first. So what does the daily currently show us? The daily shows us we failed to run the high. Market's coming down aggressively. What else can we see? The last weekly candle failed to close bearish. The next bullish candle failed to take the high. There's a good chance we're retesting the lows. How do I know that? Market sentiment. We're investing in the stock market. Money's leaving safe havens. What's likely to happen? We're coming lower. All right. From a daily perspective, you can see price went up, kind of reacted. My sentiment right now, my fundamentals are telling me to sell. If we check the 4-hour and the 1-hour, you can now see our internal ranges are heading down, which I will explain to you guys in the next videos when we get into technicals. So push, down, push, down, push. What's the next expectation? This low to go. So we have internal ranges heading down. Sentiment is bearish, fundamentals are bearish. So this is what happened. We had an announcement that basically the market itself was trade truce deal with China is being made. So the minute that got announced, we assumed that these bearish pushes would continue. So that's our expectation. So we ended up shorting this in New York. Now this was a liquidity cycle, which again, I'll explain when we get into our next video. So for me, what do we have? We have a trending market. We're not consolidating. We're making lower lows consistently. That to me is a trending bearish market. And you can kind of see prices breaking down. So we ended up shorting this. Now, a lot of people aren't comfortable with holding over the weekend, and basically they're not comfortable with it. I am, if I have profits on the week. Sunday market open happened. We caught this short. Is this a trade I'd recommend leaving open over the weekend with the kind of gaps we have? Not if you don't have profits on the week. So we had profits from the previous week. So had we taken a big hit, we'd still be up. So that's the only way I will take a trade over the weekend. All right, let's continue. This candle basically happens on the fact that the China-US deal is getting finalized. Market's pricing it in. What's going to happen here? We're going to expect a pullback and we're going to short again. So this is the next short we align here. Same idea as before. So I don't believe we shorted yet. All right. So pay attention here. Technicals. This is called failure to break. Failed to run the high. This low becomes weak. Order flow shifts back to the downside. What's the expectation? The expectation is to retest something up here and drop down. So this was the next short I took. Again, these are all based on trade optimism and the trade wars being solved. So let's go to the 15-minute where we could see. So what do you have here? This is a 1-hour liquidity cycle. This is a 15-minute liquidity cycle. And what we have here now is the most likely scenario of this area getting retested. I won't get in too much into projections and targeting here, as we just want to talk about the 4 pillars. So we talked about sentiment, we talked about fundamentals, and we talked about market conditions, which these ones are pretty clear. So this was the next one, and I believe this one we held to 3,200, and I ended up getting 2 stacks on this. So this ended up being a, this one here, I got in a bit lower too. To be realistic with you guys, I take around 100 pip stops, anywhere from 80 to 120. So something like this, I would just stack on momentum and essentially I capitalized. This one ended up being around 600 pips combined. Again, no, I had this bias before anything happened. Notice a pattern here. Look at how the market algo is acting. You're putting in highs, puts in a high, puts in a high, fails to break. Puts in a high, puts in a high, fails to break. Same thing. As soon as that fails to break, we know the liquidity cycle is about to begin. So this is one of my entry models. One of my main entry models is the liquidity cycle. It's on this page in multiple places, and you guys can find many of these trade recaps. But like I said, we are planning on doing the beginner, intermediate, and advanced course. The beginner will be first, probably include some intermediate, and then we'll see what kind of interest we get, if or not we release the advanced stuff on YouTube or not. It really is gonna depend on the engagement we get and how people like it. So, and just a recap for you guys. Fundamentals are bearish. Why are they bearish? Nothing's happening. Rates are not getting cut. Rates are not being raised. Although we're pricing in a cut, the key word is we're pricing in. This is already priced in a cut. We've been pricing in a cut earlier this year, so when a cut does happen, it's not unexpected. It's not going to have as much impact as everyone thinks, unless more sentiment accompanies it. And sentiment being, hey, did another war break out? Did another trade deal all of a sudden get out of hand? So for example, if US and Europe fail to make a trade deal and Trump starts threatening and tweeting, US dollar is going to crash, US stock market's going to crash, gold's going to shoot up. Or another war breaks out, let's say India and Pakistan break their truce and decide to go to war. Once again, US stock market's going to sell off and basically gold's going to pump. So gold is a safe haven. Safe havens get pumped into when sentiment says, hey, it's a risk-off environment. We don't want to be invested in the stock market. Now, I've been trading this way for quite some time, and before this tool came along, you just had to have the knowledge, and it was probably closer to 2 hours a day research. This tool has created 2 hours of research into 15 minutes, and honestly, if you're newer to trading, even if you're advanced, this saves you a lot of time. This is the power of AI in one place, and it's got all your news. What I like about this is if you don't know what the news is actually doing for your asset, we can go look at it and click on impact, and it's going to tell you what the effects are. Oh, higher than forecast. Currencies are bullish. Equities are bearish. Gold is bearish. So depending on which asset you trade, you could pretty much foolproof your system by just clicking on it, telling you what the effect will be before price even comes out, so you know what to expect and you can react. The other part of this is good. I used to spend a relentless amount of time on Twitter. All of this stuff that comes out, that's market sentiment. And if you don't have to scan Twitter for hours a day, this will basically keep track of everything for you. Now, the new thing, and this is one of the things I actually recommended to them, and I think multiple other people did, and these guys have actually listened to everything everyone recommended and added it in. Let me just see. It was calendar, I think, Trump tracker. So right now we have a very volatile president that sends a tweet and crashes the market, or the market rallies every time he says something. So I had to follow Trump's truth and Trump's Twitter. This does it for us, and it basically pushes everything into here. So all you're paying attention to is this, and if you think you missed something, you go back to home. Hey, investors are actively buying. Look at that. Liquidity is pouring into the S&P 500 and leaving safe havens. Okay, cool. Why is the risk on happening? Cool, let me read these little bubbles. Or what is the bias for my current pair? Okay, 1 hour slightly bullish, and the daily trend is slightly bearish, weekly still bullish. We scroll down, it's gonna tell us why. You can make your assessment based on this. Guys, when institutional traders or traders with big capital trade, they don't try to catch every move. They try to catch the moves where the majority of their biases on both technicals and fundamentals and sentiment are all either going up or going down. This is how you improve your hit rate. I don't care if you day trade, if you swing trade, or or intraday or whatever it is, the more aligned you are with fundamentals and sentiment, the more aligned you are with the heavier money inflows. Can you ping pong and make money against sentiment? Yes. Long term, are you going to lose more chasing every move? Yes. So what do? You pick and choose your battles. You find what works on sentiment and fundamentals and technicals. And if you can make 70% of your trades that, and maybe 30% that are a little riskier, you're going to do a lot better than the guys that just try to catch every move. I don't have a problem sitting a day out. I don't have a problem sitting a week out. I go for 200 to 700 pip moves. Because of this, I make sure I am happy with the setup. If my sentiment and my fundamentals and my technicals are all misaligned, I might sit a day or two out and wait. And that's how I trade, and this has brought me to consistency, and this has brought me to making more money in less trades. And less trades means you have less stress. I want to thank everybody for tuning in. Once again, hope you enjoyed this. Get into our Discord if you're not, and stay tuned for the videos we're going to release, where I'm going to release a whole course on how you should trade as a beginner. All right, guys, I will see you in the next video.